Okay, we'll have John Stoltzfus, who's Managing Director and Chief Investment Strategist at Oppenheimer Asset Management. John, great to have you with us here. Thank you very much. Actually, you know that I don't know if you heard that line from a local brokerage, Novama, saying, well, insiders are selling, local flow momentum is easing a little bit, and FIs are not exactly all that excited given valuations are high in India, which have always been the case. So where does it leave us, John, in your opinion?
Well, in terms of which market, the S&P 500 or India's market?
India. That was in reference to India.
Well, you know, related to India's market, we'd have to think when you get to different points. Pardon me? I couldn't hear you.
India. Go on, John. We can hear you clearly.
Related, you know, right now what you've got to consider is markets have to take time to get where they're going. A detour does not necessarily a journey end, is what we always say related to our markets. What we think here, where we are right now, is in a period in which we're beginning to see a change in the world order related to the emerging markets, which markets will be a prominent coming out of a diversification of the emerging markets, as well as from within developed international markets, but it'll be likely more pronounced in the emerging markets. And we expect of the major emerging markets, India, Mexico, Korea will likely be among the major emerging markets to benefit from some of the changes that we will see in terms of global trade. And we think that will be reflected in GDP, and ultimately it will be reflected in revenue and earnings growth.
John, hi, good morning. It's encouraging to hear you say that, because there's no deal yet between India and the US. And the US president yesterday said that he could levy up to 25% tariff, which would be higher than some of our competing Asian economies. What's your sense? The other problem with at least the Indian stock market is that earnings aren't picking up and they're fairly subdued compared to what you said. You know, China seems to be doing better now. Even Korea seems to be doing better. So can that keep foreign investors away longer?
Well, I think, you know, anytime that you see a slowing in earnings growth, naturally you're going to find investors are going to begin, some nervous investors, skeptics, and bears will likely take some profits at those particular points. But we've got to say, if you're looking for the trends intermediate to longer term, and I mean 2, 3, 4 years out, which is really what you need to look at, it would seem to us that the new order that we're envisioning is very likely to be realized. And some of this is a result, first of all, of the great financial crisis, followed by the pandemic, and then the disorder in terms of the global supply chain. I think from a perception of the tariff talks that are going on right now, these are highly complex situations to be worked out, and it is quite natural that there will be some volatility that will come into the markets and questioning in terms of where we will likely arrive to as a result of negotiations. But we think that where we are headed, because of the innovation that the United States offers, as well as the potential for manufacturing in other countries outside China. This is not to say that we believe that China will not be still remain a substantial player, but it will not be any longer all roads lead to China when it comes to the global supply chain, but yet it will be shared among countries. From a practical standpoint, it makes all the sense in the world. And usually things work out genuinely, rivers will flow where they're going to flow at the points of least resistance.
All right. Hi, John. Good to see you in this morning. Very quickly, before we let you go, the S&P 500 actually has been quite resilient, but you believe that maybe it has more in store before the end of this year. You're calling for another 10% move from here on. So tell us, what's the target on the S&P 500? And also the dollar index, you know, that's weakened a lot in the last few months. Are you calling for a bottoming out of the dollar index?
Well, let's start with the S&P 500. We came into this year with a 7,100 target for the S&P 500, and we put that in last December. By a little bit after April 2nd, we lowered our target to 5,950 because the markets had gone through a correction and then almost a bear market at one point. We were down 18.9% from February 19, from the peak to a low on April 8th. From that point, we've rallied, we've regained, we're back at new highs. And we do believe that the process that is beginning to be seen, whether it's with the agreements that have so far been more than sketched out, but still not absolutely locked in stone, but the ones that we've seen with Japan, as well as the most recent one over the weekend with the EU, we think these are pointing the way to the tariffs risks that have been felt by the market, and the concerns about earnings will likely be ameliorated enough to see gains of around 10, 11% from here to the end of the year. And that is in process what we've seen. We've seen a broadening of the S&P 500 rally. If you look at it right now, industrials is the best performing sector on a year-to-date basis,
Right.
and also from the lows. This would tell us that
Indeed.
the market is definitely broadening. Related to the dollar last year, based on the Bloomberg Dollar Index, as I recall, was up about 8%. The dollar this year has fallen, about my recollection, at the depth down around 10%. We saw some strengthening in the dollar.
Right.
That has come back. That is likely going to settle, but still at a point it'll bottom out, but at a position where we expect the dollar will remain the reserve currency of the world. If you consider all currencies being dirty shirts in a basket of dirty shirts, the U.S. tends to be the cleanest dirty shirt, and ultimately, it is the dollar is the reserve currency of the world because of the transparency, governance, and innovation the economy has.
If the S&P 500 does indeed do that 10%, 10 to 11%, move up from here, it'll be a great year for U.S. equities once again. Then, good to have you on the show, John. Look forward to the next one. We'll have a longer conversation on India next time you're around. Thanks for joining in.